So the biggest impact that the trade war is having so far is that it's creating uncertainty. And as you know, uncertainty is not good for any markets. They don't like uncertainty at all. What we're seeing is a pullback in CapEx spending in the manufacturing sector in the United States. And you can see that as evidenced by the contraction in the PMI number for the first time since 2009. In and of itself, this is not a bad thing for credit, because our companies are behaving more defensively. That's not good for the general economy, but it is good for credit as they shore up their balance sheets and become more defensive. In terms of what we can expect in the medium term, I think headline risk is still clearly going to be a factor. That's a great question. We believe that they will cut again in September. After one cut last month, and potentially one more before the end of the year. But it's important to remember that what we've seen in the past few months from the FOMC is a big shift in their focus. They are now focusing very much on hitting their inflation target. So in the past, the focus was on growth and jobs and unemployment, but now you hear them talking much more about inflation, and we have been unable to reach our goal. So we think that it will become data dependent on the inflation, and that they will continue to be accommodative. And for the first time in the past few weeks, we've seen them already talking about asset purchases. So it may be that the rate cutting cycle will not be as significant, but that they move to asset purchases much quicker than in the past. Sure. So for investors in institutional portfolios, we think investment grade credit will continue to be the safe haven relative to other markets. It will perform much better even in a downturn, as we've seen significant demand, particularly from foreigners. As you know, with over $16 trillion in negative yielding debt, the U.S. market stands out as a good place to get some decent yield without taking significant risk. So we think it will continue to benefit from that. In terms of risks, including this in a portfolio, we think that one of the underappreciated risks in credit is duration. And we have benefited for the past several years from this move to lower yields, and particularly this year, posting significant positive returns. And we need to remember as investors that can go the other way. So for example, long credit portfolios are up 20% this year. That's a very big number for investment grade assets. Keep in mind that can go the other way. So that is a risk that I think is underappreciated.